Welcome to Module 3, comparing Bitcoin and traditional Treasury assets. So far, we've made the case that the traditional reserve model is breaking down and that Bitcoin is increasingly being viewed as a strategic alternative. But no treasurer, whether a corporate CFO or a central bank reserve manager, is evaluating Bitcoin in isolation. It's one option among many, competing with cash, bonds, equities, gold, and real estate. Each of these assets serves a different role on the balance sheet. Each comes with its own strengths, weaknesses, and trade-offs. If Bitcoin is gaining traction as a strategic reserve, the natural next question is, compared to what? To understand where Bitcoin fits, we need to walk through each major category of treasury allocation and evaluate them based on risk, liquidity, growth potential, and counterparty exposure. Let's start with cash. Every business needs cash for working capital and short-term obligations. It's the lifeblood of operations, and every nation-state needs some amount of fiat currency for managing domestic liquidity and international trade. But as a long-term store of value, cash is among the weakest options. It currently earns 4% annually in 2025 within the United States, and some years currency debasement or inflation may erase that return altogether. Cash is liquid and convenient, but it offers no upside and it carries full exposure to debasement. It is, by design, a guaranteed loss relative to monetary expansion over the long run. It's better thought of as a short-term tool, not a long-term asset. Bonds are next. They've historically offered a modest yield in exchange for duration and credit risk. In theory, they help smooth volatility, but in recent years, bonds have struggled to deliver real returns. Rising interest rates have crushed the price of long-duration debt, while inflation has eaten into real yields across the board. In fact, as of May 2025, U.S. Treasury bonds now have the worst 10-year rolling annualized returns in the last 90 years. And for sovereigns, the risk with bonds doesn't stop with underperformance. Holding foreign government bonds as reserves can create geopolitical and credit exposure to adversarial regimes, something many nations learned firsthand when dollar and euro reserves were frozen. Just like cash, bonds ultimately rely on the solvency of governments and central bank policy, making them fragile in a high-debt, high-deficit world. What about equities? Equities offer growth, but they come with complexities and contradictions. Managing equities takes resources. It's often outside a company's core competency to pick stocks. Allocating to broad equity indices means you're potentially injecting capital into your competitors. Imagine if Coca-Cola bought the S&P 500. That would mean it bought some Pepsi shares. You can see how awkward of a dynamic this creates. Plus, there's a structural limitation. If a company allocates more than 40% of its balance sheet to equities, it risks being reclassified as an investment company under US law. That invites a new layer of compliance burdens most CFOs do not want to deal with. In the end, holding equities introduces all kinds of financial risk factors, including currency risk, political risk, management risk, and competition risk. So although equities might offer upside, they're not ideal as a treasury reserve asset. They come with all kinds of headaches and volatility. And that leads us to real estate. Real estate can serve as an inflation hedge and it generates income, but it's illiquid, geographically constrained, and exposed to regulatory and tax risks. It also requires ongoing maintenance and has significant overhead. Plus, being physical in nature comes with all kinds of additional risk factors. Corporate treasurers cannot afford to worry about a hurricane wiping out part of their reserves. Likewise, sovereign nations should not have a portion of their strategic reserves tied to the real estate cycle of a single city or region. And now that brings us to gold. As we mentioned in Module 2, central banks have been buying gold at a record rate. But are they making a mistake? Gold has history and is reasonably scarce, but it is also slow, expensive to move, and costly to store. And over time, its supply gets diluted with new supply from miners, just like fiat. The global stock of gold grows by 1 to 2% per year. That means corporate holders of gold are gradually diluted. That may not sound like much, but at 2% annual inflation, a company's purchasing power is cut in half roughly every 35 years. Which brings us back to Bitcoin. Bitcoin has many properties that make it an attractive monetary asset relative to both fiat and gold. Bitcoin is inexpensive to store and easy to move, and most importantly, it has a hard cap on its supply. It won't be diluted over time like fiat or gold. As this chart shows, gold may have history, but Bitcoin has scarcity. Given these superior monetary characteristics, it's no surprise that Bitcoin has outperformed all other asset classes over longer time frames. Bitcoin's returns have vastly outperformed the rate of inflation, while other asset classes have lagged behind. But here's an important point. It's not just that Bitcoin has outperformed, it's that it has done so while remaining uncorrelated to other asset classes. This is the holy grail for treasurers, corporate or sovereign alike, an asset that can drive returns while providing diversification. The correlation matrix below shows how Bitcoin has had low to moderate 90-day rolling correlation to all other major asset classes. Because when constructing a treasury strategy, it's not just about the total return of the asset, it's the risk-adjusted return. The good news is, Bitcoin risk-adjusted returns are literally off the charts. This chart highlights how much return an asset has delivered for a given amount of downside risk using the Sortino ratio. As you can see, Bitcoin is in a league of its own. Even a small amount of Bitcoin boosted returns without making the portfolio much more volatile. Bitcoin allocation has left its speculative era and entered a whole new one. Because in a world where every traditional asset class is increasingly correlated and increasingly exposed to systemic fragility, Bitcoin offers something different. It offers an exit from the existing risk matrix. It doesn't rely on central banks, it doesn't depend on counterparties, and it isn't someone else's liability. Of course, Bitcoin has its risks, with volatility being the most obvious one. But for institutions with long-term horizons and a mandate to protect purchasing power, those risks can be managed with proper position sizing. What's harder to manage is the structural risk embedded in traditional assets, especially in a world of persistent deficits, rising debt to GDP ratio, and financial repression. Bitcoin offers asymmetric upside with uncorrelated return potential. And for treasurers managing public or private capital in uncertain times, that combination is rare. So when we ask, where does Bitcoin fit? The answer is simple. Whether you're managing a sovereign reserve portfolio or a corporate balance sheet, Bitcoin doesn't replace everything. It complements the rest. This wraps up Module 3. In Module 4, we'll explore how corporations are already putting this into action and what adoption looks like in practice.